We're live.
Perfect. Hey guys, been a little while since we've done one of these. Been a crazy few weeks. Really interesting products and stuff to show you at our upcoming conferences, and yeah, some really interesting things cooking in the background. As you guys saw yesterday, Andre announced FT. I think it's going to be really interesting. And yeah, it's going to be a really cool few months for different products and then services that we're going to launch, and then basically trying to make the chain the ecosystem on the chain more robust. Um, Billy and I were just talking before we got on here about something I find interesting is that when there's a big downturn, most people are disappointed. And obviously, like a lot of people lose money, and we all obviously want it to go up for long. But Billy mentioned something interesting that there's a rush of OEV to be had when these things happen. So I think it's obviously not saying that things are going to crash now because we've had a big run, but like if it does, and then things are sort of volatile, I think last couple of days, it would be interesting to know how to sort of extract value from that and sort of capitalize on some of these shifts. So I think it's a good time to have the next episode of Billy Jitsu with API 3. Billy, what are you gonna show us today?
Yeah, hi, welcome everybody. Yeah, so for those that haven't been kind of watching along or just watching this first episode, we've been going through an ongoing series of like becoming a beginner searcher, right? So, for searcher's life, sometimes you can go 2-3 months without making any money, and then in 1 hour you make all the money that you need for the year, right? So like that is where you see it all the time. I think you saw it a couple of days ago. Billions of dollars liquidated from centralized exchanges, right? But what about these, borrow lending dexes? How do we take a part of it when we see these things happening? And that's kind of how I'm showing you how to get into it, understanding the flow, understanding a liquidation, which brings us into liquidations today. So I'm going to bring up my PowerPoint so you can kind of see where we've been at and where we're going to go. And then let's get right into it. So I'm going to share my screen, my entire one. There we go. And let's see, bring it up. There we go. So for those that don't know or just catching up, API 3 oracles that pay you, you're going to understand exactly why. We basically do price feeds, right? Plenty of services that do that. The EVM basically doesn't know what the actual price of ETH is in USD value or wrap BTC or any of those. So you need oracles to bring that down so you can create a money market like a borrow lending DApp, perpetuals, any kind of things that require off-chain data. We specifically do it for price feeds because those are very, very sensitive on there. If you do a misreport, causes a lot of bad things, right? If he's $2. So for development support, if this video sparks your interest, you want to learn more about API 3, I am your developer advocate, DevRel, all that integrations. You can hit me on Telegram, which is Billy Jitsu, or on my Twitter, which is the QR code. If you enjoy half decent takes and then half nonsense takes and just my regular dad jokes, I'm the guy for you. But yeah, so just to recap for everything, first workshop was the fundamentals of API 3, how to use it, API 3 feed, discover how to use the marketplace, really, really simple. I think we did that in 10 minutes. And then we got into like being to like forking code that maybe you wanted to fork Aave or Compound and you wanted to bring that to Sonic and you didn't want to refactor stuff, showed you how to use an adapter. Or if you wanted to use, straight oracles, you can show you how compatible that was. So you can see that we're across multiple different chains. So whatever you see somewhere else, you can bring over to Sonic. Second workshop was explaining how the oracles actually pay you. OEV, basically understanding how push oracles and pull oracles work. What's the difference? Why do they matter? And then we actually updated a real-time price on Sonic Network to show you exactly how that works to get the most exact price on chain. And we are currently in the third era of the workshop where we actually, on the last session, deployed Aave. We did a fork of Aave. We listed some tokens. We basically showed you how to do the CLI tool. And now today we are actually going to learn how to liquidate a person with a simple function call. It's literally one function call today. It's not about calling the function. It's knowing when to call the function and understanding how it works. And then once we do that, we're going to do it a little bit more productive wise. And we're going to actually going to do it with the OEV network and a smart contract on there. So it's a 3-part workshop because I don't want to rush it into 1 hour and say, hey, good luck. You guys are professionals. I want you to go step by step on it to understand the exact flow. So we're going to use that forked Aave that we did from the last session, and we're going to build off of that to do that today. I also sent you, Seg, the GitHub of what we're going to be working off of. So if you want to share that to the chat, it would be super
I'll
awesome.
put that underneath the main
On the
tweet.
private chat. Yeah. And so
Okay.
then the fourth workshop is flash loans. Like, it's great that I can liquidate someone, but I don't know anybody that's willing to risk $1 million just sitting in their wallet waiting for that opportunity to pop up randomly, like once every 2 months or once whenever there's a cascade. So we have flash loans. Why not borrow the money? Borrow, $1 million, perform the flash loan, pay back the $1 million, and keep the profit. That's exactly what I'm going to show you what to do. We can do that on Tenderly or BuildBear. And then the final thing was we put it all together. We bid on the OEV network, we find the liquidation, we borrow the money, pay it back, all profit without having any money in our smart contract, right? So that's where we want to go. You can make money without having a lot of money in your smart contract to begin with. And that's what it's all about, right? Becoming a searcher, finding that profit. So today is where we're going to perform an actual liquidation on a system. The last workshop, it was more about getting you to deploy Aave, not really understand how it works, but just the mechanics of how it works, how to list a token, how to get that all up and running so you can actually use it yourself and play around with it. Now we got to understand how does this thing work, right? So workshop breakdown, key learning points is how borrow lending works, right? Over collateralized loans, loan to value, LTV, calculating liquidation prices, and then mechanics of a liquidation, right? How does an unhealthy position get healthy again, right? How does liquidation work, and how does it keep the platform safe? And then the flow of the token transactions that you see on chain, right? When the liquidation happens and someone posts like an Etherscan thing, you're like, what? Right? So I'm going to go ahead and break that down piece by piece for you as well. So a lot of things that we have to do especially for people that don't understand DeFi or just kind of getting into it, is the terminology, right? You're going to hear these words all the time. And so it's here to explain, like, sometimes people are afraid to ask, I'm here to tell you, right? Collateral is the asset that serves as your security deposit, right? If I want to pay to play, what do I have to put in, right? If I want to deposit ETH, that is my collateral, right? I want to use ETH as my collateral and I want to borrow something else, right? Over collateralization is, in this space, you have to put something worth more of value in order to borrow something a little bit less. Why does that work? Because you need a reason to pay it back, right? If I put in $100 and I borrow 70, I'm incentivized to pay back that $70 because there's $30 of mine that I would lose if I didn't pay it back, right? If it was like uncollateralized or under collateralized loans, like a credit card, why would I pay it back on chain? I just roll a new wallet and take the profits and take off, right? There's no negative impact for me because I could just roll a new wallet. I don't have to like do an identity or whatnot, right? So most of the borrow lending stuff that you see, I think 99.9% is always going to be over collateralized, right? You have to put something of value that's higher than what you're going to borrow it out, right? And it's kind of touched into under collateralized, where you don't really have, you could have zero collateralization like a credit card and they trust you to pay it back, right? And then liquidation, obviously the focus of the workshop today is, if the collateral gets to a certain value where it's getting close to how much you borrowed, then we got to liquidate, right? We're going to pay back the loan in your behalf. And there is a reason for me to actually do that, right? And there's an incentive for me to make money. And that's where that money is made. So what is a borrow lending drop? Basically, it's a bank, right? People deposit, do savings and loans, put a checking account, right? And with that money, the bank does something to make money, right? So as a user on a borrow lending app, let's say Aave, we have some collateral, right? I have this ETH. I want to leverage it, right? That's something I do as a DeFi strategy myself. I have an ETH. I believe it's going to go up. So I want to deposit my ETH. I want to borrow some USDC, right? So my ETH is deposited. I open up a position. I want to borrow some USDC. Right. What do I do with that USDC? Well, I could buy more ETH and long it. Right. It was a good move for me to do that, a couple of weeks ago, and to ride that up because I believe ETH is going to go up. I didn't want to sell it. So I exposed myself to more ETH, and then it goes up. I sell it, and then I, pay back my debt and I keep the profit. Right. And then in order for me to get my ETH back, the original one, I have to pay back my USDC and it unlocks the ETH, right? And then I can get my ETH back and then I do whatever I want. Business is done. But the borrow lending app does make money because they do charge interest on that USDC. So if I borrow $100 of USDC and it's a 10% interest, at the end of the year, I do owe like 100 and a few bucks because it is compounded, right? So the most important thing about this whole thing is your health factor. You hear health factor all the time, and that is basically this formula that you will see everywhere, wherever you go. It's the value of your collateral, so the value of your ETH times the liquidation threshold. What is a liquidation threshold? That is decided by the borrow lending DApp, either the DAO or the owners of the platform. They decide what that liquidation threshold. Let's say ETH to USD, liquidation threshold is 75%. You'll see something on Morpho, that's like sometimes you'll see it at 85%, right? But it's pretty close in that range of 70 to 85%. You'll start seeing most of those very high exotic ones. You can see as low as 60%. So really depends on the asset that you're doing, right? But like blue chips like wrap BTC or ETH or anything like that, you see the liquidation threshold is usually about 75%. And that is divided by your value of how much you debt. So if I put in $1,000 and this is a 75% threshold, the most I could probably borrow is maybe $700. And then my health factor will be just about 1. And we'll go through the math in a little bit on there, but go for it. I saw a question.
No, I was going to say that if they go below if they go below 1, then you get liquidated, correct?
Yep, you
Okay.
are unlocked to be liquidated. Yeah. So just another part on here is right. Good segue. Is this is your borrowing capacity, right? So the value of collateral versus the liquidation threshold. So if I have $1,000 of ETH, right, and the liquidation threshold is 75%, it probably doesn't let me borrow up to maybe 70%. So there's like a 5% little cushion on there. So that's how much I can actually borrow at that cap, at that value. If ETH goes into 2,000, it just goes for a run, then I can borrow $1,400, right? So like it just depends on the value of the collateral. The liquidation is how much I can actually borrow. Do we want to borrow to the edge? If I was a degen, yay. Sometimes I borrow below that, right? Because I want to keep my health factor, happy in case we get these crazy liquidations, right? But anything less than 0 is liquidable, right? And there's bots watching, so it's not like, oh, 1 second, hopefully nobody notices. Everybody notices on there. So there's the liquidation threshold, which is usually like a 5%, 6% margin. That gives you a secure margin in case there's a little volatility. But as we've been seeing lately in the market, 5% is nothing right here. We drop 15%, 10%, then we come back 20%. So there are these things where we get these quick dips, and then you see all these notifications. Hey, this whole market got liquidated for $1 billion, and now we're back up to the same price, right? So it's a crazy world here. And so just so you know that I'm going to dig it in your head, when your health factor goes below 1, your borrowing position becomes liquidable, right? That's the name of the game here. So how does this work, right? I kind of explained it a little bit, but I like to do a lot of visuals, right? I say 1 ETH is worth $2,000. I should probably update this to 4,000. But let's say my borrowing capacity is up to $1,500 USDC, right? I borrow $1,250. This is my debt. So I have that. I'm doing something with it. I'm investing. Maybe I do an LP position or something. Now, all of a sudden, ETH drops down to 1,600, right? We just got a flash crash, 1,600. My borrowing capacity on the formula is only $1,200, right? I am over that limit. My health factor is no good, below 0. That's because my liquidation threshold is at 75%, right? And I can be liquidating, right? So my health factor is 0.96. This is the danger zone. When you wake up or you walked away and nothing paid it back, you will get liquidated. I can guarantee you. So why are liquidations important? Because they all sound pretty evil, right? If assets are losing value, users need a reason to pay back this loan, right? So like if I have $1,000 of ETH and I have $700 of USDC, and for some reason ETH goes down to $600 for whatever reason, like it goes and nobody liquidates me, why would I ever pay back that loan, right? I have $700 in my wallet. Why would I ever pay back that loan if it's $600? I'm giving up $100, right? So in that case, there needs to be some kind of incentive saying somebody else has to pay it before it gets to that point, right? If it gets to a certain point where it's like, hey, you're getting kind of close, where it's getting dangerous for the bank needs to incentivize something for people to pay it back. Otherwise, you get something called bad debt on there, right? So again, if the borrower doesn't pay back the loan, who will? right? So in order for me or you or anybody watching this becoming a searcher after this video, you realize there's got to be incentivization in order for you to play this game, right? So the platform can decide how much you get paid, right? So right now we know Aave will let you pay back 50% of the debt. Compound has a close factor. Usually it's about 50%. DYDX, Morpho lets you pay back the entire loan, 100% of the loan. And you usually get about 5 to 10% reward for paying back that loan. So, on $1 million, 5% is pretty hefty, right? And you see a couple $1 million liquidations, that's, a lot of people's yearly income made in one single transaction, right? And that's just one position. Imagine multiple positions, right? So obviously there's a fight for the liquidations on there. So let's do some math. I know we're going to zoom in. I try to make this as big as possible, but we're going to do some math of like, how do the liquidations actually work? Because I've always wondered this, like, somebody has bad debt, why would I borrow that, right? What are the incentives to keep this platform healthy? So we're going to take the scenario with simple numbers to keep this, as simple as possible, right? So we know the borrow cap is 70%. We're going to use that same ETH USDC value, right? Liquidation is 75%. We know this. One ETH is $1,000. Just simple math. We have a close factor of 50%. So we know that we can pay back 50% of the loan. And the liquidation spread we're giving is 1.01, right? And so I can borrow up to $700 USDC in value, right? So we're going to go back to that same formula. The value and liquidation threshold divided by the debt gives me my health factor, right? So I have $1,000 in ETH. I have the 75% liquidation threshold, and I have borrowed $700. My health factor right now at this point is 1.07. I'm healthy, but I am dangerously close to getting liquidated, right? And so let's say ETH drops the price to $900, right? It just flash crashes. Now we're at $900. And so now with that same formula, same depth and everything, my health factor is now 0.96428, right? So now I can be liquidated. So as a liquidator, I got to look at this position and say, hey, there's an opportunity for me. Let me see what happens, right? So the max step I can repay because of the close factor is the borrowed amount and times the close factor, which is 50%. The max I can pay back is 350, right? So I can pay 350. So what I'm going to do is this formula is a collateral to receive is it's a formula that we use is the debt repaid divided by 1 minus the liquidation spread. So 1 minus 0.1 and the current asset price. This is going to let me know how much money I'm going to make, right? So the debt repaid is going to be 350, which is 1 minus the liquidation spread. And then the current asset price is $900, right? So that's going to give me 0.4321 ETH, right, in total. And then if I swap that, I know that's going to be worth, 400 and some change off the top of my head, right? So the depositor's remaining collateral, right? They deposited 1 ETH and they're going to lose 0.4321 ETH, right? And so they're going to be left with 0.5679 ETH in their balance, right? Because we paid half of their debt and they had to pay out that reward on there, right? And so once I do that liquidation, the depositor's remaining debt, I paid half their debt instead of 700, they now owe 350, right? So now that I pay back their loan, right, they now have 0.5679 ETH, and ETH is worth $900 times the liquidation threshold, which is 75%, divided by their new debt because they just got paid back, and that brings their health factor up above 1.09, right? Doesn't stop ETH from falling. If ETH keeps going down, I can liquidate it again, and if it goes down again, it can liquidate it again, right? But now the user value has dropped a little bit because they have that $700 USDC, which they had in their wallet, right? They borrowed it for whatever reason. And now they have a new balance, right, of 0.5679 ETH, and that's valued at $900 minus the 350 debt. That leaves them with a balance of 861.11, right? And that's also if ETH goes back up, their balance will be a little bit closer to the 1,000. But because ETH is at $900, they have a little bit less debt. I'm sorry, less value on there. But that's the way the liquidations get you healthy, right? So if you're getting close to liquidation factor, someone can liquidate you, bring you back to a healthy factor. Assuming the asset price stays the same, you're going to stay healthy. But if the asset price keeps going down, we can keep liquidating over and over and over again until you repay that debt or add more collateral on there. Hopefully that makes sense. I'm leaving that on there. You can screenshot it or however you want to do it. but this is the formula that makes the most sense for me. And I wanted to show you all in one simple position, saying, if the debt is going down, how does their health factor go up, right? That's the question. When I first started, I asked all the time, I was like, why would I pay back this debt? Or how does it get healthy again, right? So it's a very tight formula, so it has to happen pretty quick. If that health factor gets too low, you don't bring it back to health again, and then it's not worth it. And then we have something called bad debt. So it has to be executed pretty fast.
I think it's important to note here, like what, like people might be asking, like why is bad debt an issue? Like if you just let the position go into that, the issue is then basically, correct me if I'm wrong, it basically pushes the burden of the debt onto all the other people in the pool, and that basically then sort of socializes the loss in a way,
In the
and
sense, yeah. Yeah.
and so that's why it's important to, that's why these sort of evil liquidations are important, because it actually like protects the larger I guess pool, right? For most lending bar protocols, and correct me
Yeah.
if I'm wrong. Yeah.
Yeah, well, I mean, look, so let's say I'm a depositor of USDC, right? So in order for a borrow lending app to lend out USDC, somebody has to deposit it, in a sense, right? So I'm depositing USDC. Let's say you borrowed that debt, that 350, and so now I want to pull my $700 out, but wait a minute, it's not there, right? Because nobody paid back that loan. So now I can't pull back my entire balance because we have bad debt, and so say, hey, we can give you some ETH, but it's less than what you deposited, right? And so now we have this bank issue. It's like we have this bank run. Everybody's like, oh no, I can't pull out my money. Everybody bank runs it, and like basically causes a cascade failure. And we've seen that happen many times in like the Terra Luna type of things. So the liquidations was what helped keep things important, right? And now we have treasuries that help, recover bad debt and stuff, but bad debt is always something that is scary. So we see stuff in the new kind of DeFi system where they isolate certain markets and there's a certain cap on certain markets. So yeah, there is the number one worry is you deposit $1,000, you should be able to get $1,000 back plus your interest, right? So that's the theory we want. Yeah.
Right.
Yeah. So we kind of know the math. What's the liquidation of the token flow itself, right? So what we expect to happen is, I pay back this loan and we get a reward, right? That's what I'm hoping to see on chain, but that's not what we see on chain whatsoever, right? So this is what we see. We see this kind of simplistic liquidation on here that makes way no sense to me on here until you break it down piece by piece. But this is something you'll see on an Etherscan. And most times when you see a liquidation, you'll probably see double the amount because there's more interactions happening because there's swaps and everything. This is just the liquidation right here. So we're going to right here. This is the liquidator wallet, right? And I'm paying back 50% of the debt right here. I'm transferring some tokens right here. I'm using this fake API 3 token. And so I'm paying back 50,000 of these tokens because I was 100,000 leveraged, right? So I'm paying back 50% of this debt as a liquidator, paying back the debt first because that's what has to happen, right? Borrow wallet, there's some interest earning on there because they deposit, right? So they're earning interest on their deposit. That interest, that quick interest gets burned really quick, right? Because they no longer have that amount anymore, right? And then from here, I get a payout for this received for paying back the loan, right? So for me as the loan or liquidator paying back the loan, I get a reward in the original collateral token to get paid back to me, right? It's not going to give it back to USDC. It's going to give me back on the collateral token, which was API 3 token, that mock API 3. Then because we pay back the debt, that debt token gets burned from the borrower's wallet. So that has been paid back. This debt has been paid. So that 350 example, that got paid back, right? And then interest earned on that block just gets burned. Just gets burned. So like every block you earn a little bit of interest, but for this one, no interest earned because it's gone, right? But that's the flow, right? Pay back, borrow on, like this interest earning goes away. I get the collateral tokens, the debt tokens get burned, and then any interest burned on that block is just tossed away. And that's what you're going to see on every transaction that happens, at least in an Aave transaction, of how those flows go, because they're not using native, E tokens, are using Aave tokens, right? So those are interest bearing or debt bearing tokens that will need to get burned, and they have the ability to pull those from your wallet because if someone liquidates you, you no longer have the rights to do that, right? So that's pretty much what the flow looks like. So if you're trying to understand what it is, or if you're trying to put it on ChatGPT or Claude, and they have these breakdowns, if you copy this and you try to get a flow going, sometimes it gets it, sometimes it doesn't. So come back to this video, watch it to see the flow of the transactions that actually happen. Boom. All right. So I wanted to visualize this token flow as well. So you can see exactly what's happening, right? So here's this token flow. 1 ETH is $1,000. I'm just using solid numbers, so it's easier to do the math, right? So me, I'm the borrow lending DApp. I'm the default user. I deposited my 1 ETH and I borrowed that $700 of USDC, right? So in my wallet, I have this credit of 1 Aave ETH, right? That's earning yield. And then this $700 of USDC that's also earning some debt, right? So like I got to pay interest on that. Me and the liquidator, I'm salivating. I say, ooh, there's $700 USDC that I can pay back a loan on. I'm going to have this $350 USDC on standby, right? It's not what we would do in production, but we're going to pretend that's what we have right now. So what happens, right? The liquidation price, the ETH goes to $900. We have the liquidation available, right? Me as the liquidator, I'm going to pay back half of that loan, right? So I'm going to pay $350 USDC. We pay 50% of that right here. And so I'm going to pay that down. In the default user's wallet, that $700 of variable debt USD now becomes 350. This gets burned. So that transaction where that thing got burned on that same block, that 350 got burnt out, right? Borrow lending DApp still has this system right here. I'm just showing you the liquidators paying back, and in the default wallet that got burned, right? Then what it's going to say, hey, you paid back the loan, right? Let me send you some ETH from the borrow lending DApp. Let me get you covered right here. So let me send you your reward, right? So I'm getting 0.4321 ETH on there as a reward for paying back that loan. At $900, that's worth $388 for me. So I made a profit, right? I made what, $38.89 profit for paying that loan. In that same pace, that default user, their 1A ETH now gets lowered to 0.5679 ETH in their wallet, right? Because they had to use that to pay back my position, right? And now in the borrow lending DApp, there's only 0.5679 ETH available and 350 USDC debt, right? So that's where it all balances out. And it pulls from this wallet, goes to this wallet. So that's where the exchange of flow of all these transactions are happening on there. Maybe it's easier to visually see it this way. So you say, oh, okay, this is what's happening between all the wallets versus just what's happening through the contracts, right? So I just want to kind of explain that flow of the transactions of everything that happens all in that same block, because it all happens like atomically in a sense. Make sense so far?
Yeah, I think this diagram really helps make it clear,
Cool.
and it's all like happening all at the same time
Yep.
because it's important that there's no delay in between each of these actions. Yeah.
Yep. 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 Boom. So what assets do you get back? I kind of hinted at it a little bit, but I didn't. So you get the asset they deposited as collateral with multiple deposits, right? If I popped in Wrap BTC, Wrapped ETH, and Sonic, right? Each one of those tokens has a reward for it, right? Depending on the reward or the liquidation spread, you can get 5 to 10% reward back, right? So if Wrap BTC has a reward of 5%, Wrapped ETH has a reward of 5%, and Sonic has a reward of 10%, as a liquidator, which one would I choose? The 10% one, right? So as savvy liquidators can choose, for that same amount that I pay back, I can choose the asset that I'll get in return, and then I can get a higher reward, right? So if someone's putting a little bit more of an exotic one, a token on there, I can get a higher reward. For that same risk that I'm doing to pay, I can get a much higher return for. So that's something to consider, the collateral that you choose when you do a liquidation, because you get to choose the liquidation that you get depending on the position that they have, right? So that is something also to consider. In this example, I'm just doing one-to-one. I'm going to deposit some API3 tokens and I'm going to borrow USDC. There's only one collateral for me to choose from to make it easy. But if there are multiple collateral options on there and they're using multiple, tokens to do that, you can choose, and then you're going to know beforehand. You're going to look at the docs and you're going to see the reward rate for each one of these. But you're going to choose, oh, this is the one that has a higher reward. I can choose that one, right? So liquidations on lending protocols. We may have touched this a little bit, but just a recap on here. First thing that has to happen for this whole thing, liquidations, to even occur is the Oracle has to update, right? In order for the Oracle has to update, and then the health factor changes, right? So if ETH was $1,000 in that example, and then all of a sudden there was this huge drop, right? Just there's unexplainable black swan where it just happened, and ETH became $900. The first thing that has to happen, the Oracle has to update that value on chain. So now ETH is $900. Then all the math happens on the DEX. I'm sorry, the borrow lending. So everybody's health factor changes. Searchers see that position. Everybody fights for it, right? Everybody's fighting for the block space because they want that 5-10% on there. And then user gets liquidated, everybody gets their profit, right? But again, the first thing that has to happen is the Oracle has to update, right? And that's why we use OEV, right? Because if I have the right to update the Oracle, I avoid this whole, competition in the block space. I just bypass that whole thing and go right there, profit, right? And that's the value prop of using API 3 oracles with OEV. And then as the DApp owner, you get, that money back and you get, a much larger position profit. So again, kind of tease into it. How does OEV play into this? Everybody wants this liquidation bonus, right? On Sonic, we can't theoretically bribe any validators. Is it first come, first serve, or can the blocks be reorganized? I'm unsure on that on Sonic.
Sorry, Billy, say again.
In the sequencer, can the blocks be reorganized, or is it just first come, first serve?
No, there's no reorgs in Sonic.
Yeah.
In the way that the network's constructed. Yeah.
Yeah. So if you're a liquidator, you're basically spamming for 5 minutes, hoping that when the Oracle updates, you land on the same block, and then you're the transaction right after, right? Like without OEV,
Yeah.
that's what you're doing. So you're going to see a bunch of spam,
Yeah.
a lot of wasted gas, a lot of network congestion. So like when the market's going volatile, you're seeing all these liquidators spamming the transaction. You can't pull out your assets because everybody's spamming it, right? So
It's sort of interesting because it's like I mean it's the same occurrence again and again in different like scenarios. So if you remember NFT mints that were really
yes.
hyped because you could make a lot of money there, you'd see a lot of wasted gas as well because it's like the profit potential outweighs the wasted gas and then it blocks everybody else.
Yes.
So it's like
yeah. So that's what's literally happening on layer 2s right now. So you're seeing spam, but it's a lot cheaper to spam it, right? So it's like, pennies or, less than thousands of a penny. So, if I spend $1 spamming the entire network so I can make, $10,000, I mean, how many people are going to do that? So it really kills it. So what you do with OEV is you have the right to update the Oracle. So it doesn't matter if anybody spams it. Your transaction, whenever that goes through the spam, will update the Oracle and atomically make that liquidation, right? So that's why OEV is very important, especially for layer 2s, because you can bypass that entire system here. So that is pretty cool. Oh, okay. Yeah. Saw the message. Cool. So we're going to go right into the liquidation in a quick second, but I wanted to show you, for those that missed the Aave deployment, what we do with the contracts, right? So when we deploy Aave, you'll see that here, all these functions are all in this lending pool contract. Our deposit, withdraw, borrow, repay, which most user ends, they see that, that's what they do. But you'll also see flash loan and liquidate. We call the same functions on that same contract, right? So all we do is interact with the lending pool contract, right? We don't really mess with all the other stuff. Me as a user, me as a liquidator, I'm only interacting with the lending pool contract, right? So that's all we're going to interact with. And so enough talk. I know we talked a lot. I wanted to get the ideas with you. But here is the link to example. It's the same link to the GitHub on here, but here's a QR code if you wanted to just scan it and then use it. And then let's get to work on here. So let me go into the VS Code here so you can see it. Let's load this up. Let me yarn dev this. Yarn front. Actually, I can front end dev and get into where we left off last time here. And then I'm going to show you really quick where we are for those that have clicked the link and are kind of trying to follow along. It is the same one that we used to fork the Aave code. If you scroll down, and I try to take this step by step, right? We basically installed Docker, we deployed it, we chose the tokens that we wanted to do. We did it with our .env, we did all our markets, and we deployed. And so we stopped at this front end dev where we loaded the front end right here, and we kind of have our assets that are listed here. I did it with wrap.btc, Sonic, USDC, mock API 3, and mock wrap ETH on here. So we have this markets that we can pop in here with our very own borrow lending dApp, right? And this is pretty much where we stopped on here. And so now we're going to continue off, right? We're going to go into the liquidation. So again, we're going to step by step. You're just going to go right into setting up our positions in the dApp. I have these set scripts, but I want you to see it so you can kind of flow with it yourself, right? I'm distributing the tokens. If you remember, I used a mnemonic so we can create more and more wallets if you wanted to create positions instead of a private key. So I'm distributing the tokens to another wallet so we can have one that's a liquidator and one that is a borrow person and that over leverages, and then their value goes down, right? So I'm going to take you through this whole thing. You'll see the deposit and all this right here, and we'll stop at the mock price. But I want you to see how to use a borrow lending dApp. So I'm just going to move this to the side. I have this started up, and here we are, right? So I have this main wallet here. This is my deployer. I have 1 million tokens deposited. I'm going to supply 3 million more. And why am I supplying it this way is because in order for the bank to lend out money, somebody has to deposit money, right? So me as a big player, I'm a big whale. I want to deposit $3 million, earn some yield on here, get this market up and running so people can deposit their other assets, borrow the USDC, and start paying some debt, right? So done. All right. So right here, I have $4 million on here, depositing, trying to earn some yield. You'll see my APY is 0 because nobody's borrowing it, right? So nobody's borrowing this on here. So let's switch over to another wallet. And I'll see that my Aave deployer 2 is here. And that's where I did my distribution of tokens. So I have quite a few tokens on here for me. And you'll see that my net worth is 0. And so for this demo, I'm using this mock API 3. So I'm going to go ahead and supply. We'll just do 1,000 tokens. So I'm going to go ahead and approve that. Wait for that to approve. And then I'm going to supply it. And voila, I now have 1,000 API 3 tokens, and that is valued at $719. If we check the market here, marketapi3.org, and I kind of set this up beforehand, but just making sure our oracles are looking good. It's going to go to Sonic and just verify that on the feed, API 3 USDC. You'll see that it's 71 cents, 71.97, and that you see that my collateral here is 719 because I have $1,000 on there, and then the trailing adds it all up, right? So I have 1,000 tokens here, and now I want to borrow max, right? I want to borrow off them as much USDC I can. You can see that my collateral is here, so I'm going to borrow USDC. That's exactly what we're talking about, borrowing on here. So you see my health factor switches to 108. If I lower this to 200, my health factor is pretty healthy. It's above 1. 2 is pretty healthy on here, but I'm going to max. Let's max leverage it, right? 1.08 is all this is going to let me borrow. It's letting me know, hey, you're getting pretty close to the 1. But yes, I know this. I want to borrow this USDC. I love it. I want to borrow it. And so this is what I would do with my money, right? Maybe I want to buy more API 3. I feel the market's going up. Maybe I want to buy some ETH or anything. I don't want to sell my API 3. I want to borrow against it. And so I want to leverage it because I feel like it's going to go up, right? If I feel like it's going to go down, I would sell it, right? But I feel like it's going to go up, but I don't want to sell it yet. I want to leverage that API 3 value, buy some more of whatever, or deposit it to earn some yield. Maybe there's 10%. There's a lot of good yields. There's a lot of reasons to borrow stables or borrow ETH or do whatever, right? So now I have this position. You see that my health factor is 108. Okay, so now this is where we're at right here. So I've deposited the USDC. I did the deposit on the second wallet. I've borrowed on the second wallet. Here's where we get dangerous, right? So here is why I have the borrow lending dApp project here. So then you guys can mess with the oracles, right? So on the side here, I'm going to go ahead and bring up my wallet here. I have this little thing that I vibe coded that lets me know what the liquidation thresholds of something's going to be. And so based on my position, I want to see what my liquidation price is going to be for this position, right? I know that the value is 71 cents for each API 3 token, and my health factor is 108. So let me just do this. I'm going to increase the screen size so you can see it and get this up and running really quick. So I'm just going to do node index. And this is something I vibe coded. You can do like ChatGPT or something. I just do this for the demos, just so I can calculate this on the fly because the prices change all the time, right? So I'm going to enter my token quantity, which is 1,000 tokens I deposited, right? What is the current price of the token? Was 71.719. 0.719. I'm going to overshoot it by 1. So 0.719. Liquidation threshold for this example, we're using 0.75, so 0.75. And then my debt value, what did I borrow off here? I borrowed 498.91, so 498.91. And so based on that, with my collateral, my current health factor is 1.08. So the liquidation price per token, if API3 token went down to 67 cents, or if it had a price drop of 7%, 7.5%, I would be liquidated, right? If I didn't pay back my loan or do anything. So 67 cents is where I would be liquidable, right? So let's go back to my demo here, right? So I forked this code, I brought it here. If we go down to the scripts folder, I know there's a ton of folders here. If you go down to the scripts folder and we go to the update mock price here, this update mock price thing, you can see right here, I have a bunch of code on here. It's, you know, I don't want to go through it too much. I want you just to be able to, experiment with it and go with it. But you'll see that I have everything written out, even the ABIs written out. So you see exactly what you're doing, right? I'm not importing it. You can go through the flow of every script and kind of learn what you're going. But I want to update this mock price to that 67 cents. So right now, I think it's at $1 something. So I want to do, it's like $1.01. So I want to do 67 cents. So I'm going to go 6700. So that's about 67 cents. And so if we look right here, all I have to do is type in yarn update mock price, right? So I'm just going to yarn update mock price. It's going to go to the script where it's just going to change that value. So we're just going to wait patiently on that for that script to make its changes. And what that is the fake oracle. I'm using a fake oracle because I can't do this in production, right? I can't just change the values of something. I have to create these testing scenarios. So I created this fake oracle that's going to do it. So my transactions have been confirmed, updated the mock price. And so now, because we control the borrow lending dApp, we can change the oracle source, right? Right now it's reading, and a trusted source is reading the API3 oracle directly. So now what we're going to do, if we follow along in the next step, is we're going to change the oracle. So I want to change the oracle where it was reading from this API3, contract. This contract here was reading the price feed here. I want to change that to read the oracle that I deployed over with all the other mock stuff. I want to change it to read this one. So it's going to read as 67 cents. So I'm going to do that. I'm just going to copy and paste, change the oracle. Oops, did I do something right here? Let me delete that. I'm going to copy and paste it one more time. I'm going to right click. There we go. Change oracle. I'm just going to make that a little bit bigger so you can see that it's just change oracle. And so it's just going to switch where the oracle is reading from to this new oracle right now. So it's just going to change that. So we're just kind of waiting. Let's move this actually to the side because it's just the host. And so we should see that updated on our front end pretty soon. And so the transaction has been confirmed. And so we have the new asset proxy. So if I refresh this page, oh, it's just at 1. So let me redo. I guess I didn't do my math right here. So let me go back and update that mock proxy, mock price. And I'm just going to go to 66. Probably that spare change just made it horrible. So let me just update it one more time so we can see it. My math wasn't mathing because I didn't calculate for the extra space, but we're at health factor 1. So we were safe. We still didn't get liquidated. And I'm just waiting for this to update here on the transactions as soon as it deploys. And transaction sent. And there we go. So let's refresh, and hopefully we're at 99. If not, I'll just drop it by a whole penny. There we go. We are at 99. So I just updated that price. So we just within range went to 99. And obviously I'm not liquidated yet because we don't have bots running. They're not actively looking, but now my position can be liquidable, right? So now as a searcher, we are ready to liquidate, right? So obviously the next thing we want to do is yarn liquidate, right? We want to liquidate this position from our other wallet. But let's go ahead and break down this liquidation transaction here. So let's make this a little bit bigger, and I'm going to kind of just go step by step here. So right now I'm bringing my imports. I'm looking at all my saved files here. So if I go into here, and just to bring it back, On the adapters, under our references, you'll see that we have all our token addresses for each one of our markets. So we have wrapped BTC, wrapped ETH, S token, API3, USDC. So I have all the token addresses already here. So this is all, you don't have to store it somewhere. It's just going to read it up on the file sources. And then the same thing with our deployments, our deployed contracts. You'll see that we have the lending pool address provider. And right here is the lending pool. And this is the contract it's reading from. So when you look at the scripts, you'll see that, when it references something, it's just basically, reading the files system on here. So, oops, let me go to liquidate. So you're reading the path and then reading the files, right? So I'm just reading this back to see where the references are. So like looking at the references and looking at the deployed contracts, right? And so I am setting those out so I know which tokens I want to use and whatnot. So again, I'm just making sure that I can read the file sources. And so cool, once we read the file sources, we're looking good. And then I'm creating my mnemonic, right? And so I'm using that first wallet provider. So just to show you, let me make sure I have this well. Remember that first wallet, this is the borrowing wallet, and then the other wallet was the deployer. So the first wallet is going to be the liquidator on there. So this is the second wallet is the one with the position, right? So the user to liquidate, for those that haven't used a mnemonic on here, I'm using position 1, and then my first wallet is position 0. So if you don't know how to use create a address from a mnemonic, you pretty much derive the path depending. So if I wanted to create a second wallet, it would be the second position, third position, so on and so on, in order for us to do that. So I know that my user to liquidate is going to be this wallet address, right? And so now I'm going to find the lending pool address, which is in that address. Lending pool ABI, again, I'm doing all the ABIs directly, so then you know exactly what functions I'm going to call and basically the layout of each one. And then I want to get the user account data. So I want to see what the account data looks like. I want to make sure that I can liquidate this person, what assets they have. And then I'm literally going to call this one function liquidation call. And that's going to be like the collateral, the depth, what wallet I'm going to do, how much debt I'm going to cover. Do I want to receive the A tokens or do I want to receive the native tokens? I want to receive the native tokens. And so that's all I'm calling on here. Right. And so here I'm just making sure that I have my liquidation wallet, who's going to get liquidated. This is just more for console log. So when we script it, you can see it all kind of pump out, and then making sure that I have the lending pool address. So I'm just pulling all that information from the ABI that it created, and then which token on here. So I did API3. Again, it's referencing the token name on here. So you can see that I'm finding the asset for API3 and then the USDC address on there because I'm going to pay back that loan. And then I'm just logging that all out. So it's just easier to see as you go through it. And then I'm getting the user data, right? This is a function on the Aave that I can get the account information to see exactly how much total collateral do they have, how much debt do they have, how much available borrows, if there is any, and then what their LTV is and what their health factor, right? Those are the things that are important to me on here. And so I can find all that data when I look at them and say, okay, perfect. These guys are ready to be liquidated. Let me go ahead and liquidate. Right? And then I'm just going to format these values so I can make it in readable format because this is all with 18 decimals. So it gets kind of crazy. So on this one, I know for Aave that everything is the max step is 50%. So I can do the total depth and I basically divide it by 50% to know that that's the maximum that I can pay out, right? And then what I need to do is get that current liquidation threshold. So basically using that formula, liquidation threshold, and then format that to loan to value to make sure that I can get this. And then I kind of printed it out so you guys can see it and say, oh, okay, this is what it looks like when I analyze a position's wallet, right? And then I return all that information to let me know. Then I also check health factor, can I liquidate them or not, right? And in this transaction, can I liquidate this? If it's not, the health factor is below 0, I will get an error on there. So it'll let me know, hey, nope, no go. You can't liquidate this person anymore, but either they repaid it back or they added more collateral or something before I was able to liquidate. So, it's going to check health factor. We don't want to waste gas. So it's just a function to say, hey, let's get this user account data. Is the health factor looking good? If not, let's continue on, basically. And then the final one, right? The single function right here is like perform the liquidation. We're going to perform it, right? So I'm going to connect to the USDC contract, right? I'm just going to get the ABI from this. I'm going to see, I want to max pay back the loan, right? So I want the max units, which is 50%. And then I'm going to approve my USDC to get, paid, pulled by the contract. When I call that function, I have to let it pull from my wallet. And then I'm just going to go ahead and look at the user data. Can I liquidate them or not, right? And it's going to let me know preparing for liquidation, how much I can actually liquidate from them. And then this is the call right here. This one function right here is the one function that you call in order to actually do the liquidation, right? Really, really simple. I want to pay back the debt, which is USDC. Here's the collateral address that I want to get back in the tokens, right? It's only one collateral asset that I put in. So that's the only collateral I'm going to get back, right? Here's the liquidation that I'm going to use. This is the wallet I want to liquidate, right? Which we calculated from the mnemonic. I want the max amount that I can pay out, which is 50%, right? And do I want to receive the A tokens, right? That was the interest bearing tokens. No, I want to receive the native API 3 token. I don't want the API 3 tokens from Aave. I want the API 3 token because maybe I want to swap it on a DEX. Maybe I want to do something with it to cash out in case it goes down in value, right? So I want, as a liquidator, I want to cash in my profits now and not risk the collateral dropping more in value, right? So I want the underlying asset. If you believe in it and you want to just have more interest bearing, then you can set true. But in most cases, most people sell it on there. And then it's going to let us know the liquidation transaction has been sent, and then liquidation successful. And then it's just going to get the position data afterwards, and it's going to let us know exactly what was reduced, right? Just a bunch of console log stuff in here. And then this is the main function to call it all, right? We're going to check the health factor. It's going to let us know, hey, is the position healthy? And then it's just going to perform the liquidation, right? And it's just a little script that we run on here. So you would run it on the background. If you were searching different ones, this is what we do. The special case here that you don't notice here is my main wallet that I'm doing this with. We're doing this with an EOA wallet, right? And that's not really the case because we want to do things atomically at the same time. But for this demonstration, I want to keep it as simple as possible where we have an EOA, just call this one liquidation call, and then we're done, right? So this wallet has to have USDC in it. And so I do have USDC in there. I have enough to pay back this loan and then some, and then keep that API 3 tokens on here. So with no further ado on this, I'm just going to go ahead and yarn liquidate, and it's going to run this entire thing here. So let me just minimize this, make this a little bit bigger, and I'm just going to yarn liquidate and then watch the magic happen. So I was going to go through this free logging script that lets me know what everything's about, and we'll run this liquidation here. So we'll wait for a second, and then
Hey, Billy, quick question while that's happening.
Yeah.
You mentioned that in production you wouldn't keep like 350. Wouldn't keep 350 ready. Why is that? Like, is it because it's not interest bearing? You just leaving it not working for you, or what's the reason?
Well, I wouldn't normally, you wouldn't even do this from an EOA wallet, right? You would do this with a smart contract because EOA wallets can only send one transaction at a time unless you use some kind of like multi-send or something. But most people would do it with a smart contract liquidation that has atomic. So I can swap, liquidate, swap on a DEX, cash out, and then at the end pay back the loan and then keep the profit, right?
Makes sense.
Yeah.
Makes sense.
Yeah. So, but right now, because we're only doing one call, I'm just doing it from an EOA, and I just have to have 350. But just so we know, when we get to that point in the flash loans, it's very low risk because if I can't pay back the loan, then I never made enough profit. And so I just waste a little gas versus risking my own funds. Imagine $1 million liquidation and it fails halfway. I pay back this loan and I can't, make money. I just lost $1 million, right? So this is kind of a safe way with a flash loan where unless I have the money to pay it back with then some profit, it won't go through, right? So that's kind of why we want to do it, where you don't risk your own money, you just borrow it from someone else, pay it back, and then you walk away with the profit. But here we go. So the liquidation went through right here. So let's start right here. So we know that the user liquidated was this wallet address, and then here's all the contract addresses that we have. Again, not important for this demo, but I just want you, when you do it yourself, that you can see all the contract addresses to make sure that you're good. I'm checking the health factor. This is exactly what you get back, right? You get all these hex values on here. So I just converted the health factor. Look, 0.9925. I can liquidate, right? Position is unhealthy. I'm ready to liquidate, right? And so I'm going to fetch the user position data one more time. You see that this collateral is in ETH format, so 18 decimals. So you see that my collateral is only worth $660 here. I'm sorry, not 18 decimals. This is about 10 decimals. It's because Aave uses more trailing zeros, because when you only use 18 decimals, you can get some multiplication and division errors. So they expand the decimals, and then you have this 10 decimals to play with. So you move everything over, right? The total depth is 498 right here. And then available borrows, there's no more availability for me to borrow. The liquidation threshold is 75. So I'm reading the data on this user's position so you can see it out loud. The LTV is 70%, health factor is 99.25, and the max liquidable amount I can pay back is basically $249 is how much I can pay back in order for me to make some money, right? So I'm preparing my bot for liquidations. And again, the maximum liquidation is $249 in ETH format, but it's USDC. And then the liquidation transaction is sent, right? And liquidation is successful. And I'm fetching position after the liquidation, right? And I see that now they only have $385 left. The total debt is now $249. They can borrow a little more if they want to, but I don't see why they would. And health factor is 1.16 now. So now they're healthy again. The platform is healthy. I made my profit, right? And the debt has been reduced by a certain amount. So let's look at that on the DApp right here. And if I refresh, you'll see that now my position now is 1.16. Again, I only have $385. You see that I've lost some of my API3 tokens because I had to pay back the debt plus the bonus. And my debt is $249.46. So that is pretty much, I've made, 10% profit as a liquidator on here because I have these API3 tokens. What I didn't do was swap it for the DEX in case it went lower. And then, cash out and stabilize that profit, right? But this is how a liquidation works, right? It's one function call. Literally, let me just go back down. One function call that you have to do. It's just a matter of when, right? That's the catch. A matter of finding these positions, finding these things on Aave, Compound, Morpho, DYDX, and Silo Finance, Stability Finance, right? They use our API3 oracles on Sonic. So like finding these positions on here to get this is how you can pay back a loan. But one function call, right? So that's what I wanted to kind of like leave off right here of where you're calling this with a single EOA. You're calling it with a bit of USDC in your wallet, and you're making the magic happen, right? So the next step would be is deploying an Oracle and then doing this with OEV, right? Because there's no way we can actually update a mock proxy, right? There's no way I can say, hey, you know what? ETH should be $4,000. Let me just update that and change the Oracle on Aave. Impossible for me to do, right? Everybody has to wait. Everybody's fair game. But because this is my borrow lending DApp, I can change the oracles. I can change the Oracle price. So I can show you these demos in real time. But in a real situation, you have a contract on the ready to do this kind of thing. So the next workshop, when we ever line that up, is we're going to use this with a smart contract with OEV. And so we're going to update the Oracle value to OEV, and then we're going to liquidate with a smart contract. So we're going to fund that contract with some USDC because we're not at flash loans yet. And then within that contract, it's going to do all the magic. And then we just kind of sit back and let it do. So hopefully this was not too much to swallow. I know there's a lot of information to swallow just using borrow lending dApps, understanding leverage, understanding what happens if you don't pay back your loan in time or have enough collateral. But wanted to kind of just get you based on this initial liquidation so you can understand why people would do it. It's not evil. You're basically keeping the platform healthy, and you're keeping people on check for that. So that's pretty much the entire liquidation threshold based on an EOA. So yeah, if there's any questions or anything, we'll just start planning out for the next workshop.
I think it's pretty clear to me. I don't have any other people asking questions on Twitter right now, but I think that, I think that was super, like, at least for me, it was super insightful. I think very interesting, widely applicable topic, not only for like OEV people, but also like the initial half, I think was very informative generally. So yeah, I hope everybody took something useful away. What is your, so was this the final part of the 3-part, or was it a 3-part series from your end? Or
second one of this part. The third part is still going into liquidations, but then also using it in a smart contract. So we're going to deploy a smart contract that actually liquidates, and that's how you see it happen in real time, right? So right now we just did a simple function call from an EOA wallet through a script. That's not how it happens in real life. It's through contracts, and then they call the contract does its magic, and then it does it, and then we're just adding OEV on top of it in order to do that. And then once people understand that, then we start adding in flash loans, right? And then flash loans like, hey, let me borrow this money, let me pay it back. And then that's when you see, oh, okay, now I can see why there's low risk on it because I'm not using my own money. And that's kind of where the flow goes. Yeah.
So basically you're making free money if you position yourself correctly. So Pretty
It's
cool.
about finding these
Yeah.
positions and then executing. But if you don't know how to execute,
Yeah.
no point in finding them, in a sense.
Exactly. Yeah. Yeah.
Yeah.
Yeah.
Yeah.
100%. Okay, thanks so much, Billy. Another really informative episode. We will return hopefully with Billy with the next part from API 3
Mhm.
at some point in the future, usually on Fridays, whenever we mutually find time. And we have really cool stuff coming for Sonic and others soon. And really interesting, I think, a few other episodes that are sort of teed up. So tune in on Fridays and like once in a while we'll have an episode. I think these days are really busy, but yeah, I mean we'll pre-market them and then yeah, stay tuned and follow Billy. Billy, could you shout out API 3 and your Twitter as well?
API 3 DAO, yeah, API 3 DAO. I'll type it for you really quick on there, so you can see all the updates, or you could check on the OEV stats whenever we have a crazy market on here. 1 second. API 3 DAO. I'm just going to put it in the private chat and you can share it on there as well. But I
Awesome,
have it
thanks.
linked on my Twitter as well. But yeah,
Sick, thank you. Appreciate your time, man.
of course, of course.
All right.
Always happy to spread the gospel of DeFi.
Yeah, 100%. Okay, see you guys later. See you guys in the future. Take care. Bye bye.
See ya.